In this session, we would be primarily focusing on the term structure of the interest rates, right? How these term structures are typically created, what kind of models are used as a part of interest rate term structure, and probably I will also touch upon how do we typically value a bond, probably with option or without option. How do we value these kind of bonds, or probably how do I value the worth of an option which is embedded in a particular bond. All these things we will typically look at, and probably we would also spend some time in terms of understanding how do I value swaps using the term structure of the models. So these are some of the core aspects that we will look at as a part of this particular session. So as far as the term structures are concerned, we are first covering a concept called the interest rate tree, which is primarily covering what could be the interest rates at different points in time starting from today. So probably if I am saying this is today, I am more interested in talking about what could be the interest rates probably after 1 year, after 2 years, what could be the interest rates at different points in time, right? So this kind of a tree that we are making based on some understanding. What is that understanding? Based on what would be the movement of the interest rates in future, what could be the volatility of the interest rates in the future. Based on the various assumptions, we are trying to build a tree kind of thing, and if in this tree we are creating two paths from every path, means as of today, from today I am expecting that after 1 year the interest rate either can go here or can go here. So 1 year rate can be either this number or this number. If at all we are talking about one of the two possible values, we are creating only two possible values for the next period and saying that the interest rates will reach either this or this. Such a kind of a tree is what we call as a binomial interest rate tree. We have used the similar mechanisms in valuing the options on equities using a binomial tree model. The same model, the binomial tree is nothing but two specific paths from any one single point in time. So here we are talking about the interest rates can be either this or this. Okay, if at all after 1 year the interest rate reaches here, then a year later it may touch either this or this. But if after 1 year the interest rate comes here, then after one more year I am expecting that either this or this will be the possible interest rate. This kind of a tree where we are creating two paths at the end of from each particular node is what we are calling as a binomial tree. And based on this binomial tree today, we can value the options, we can value the bonds, we can do so many things using this binomial tree model. But how do I decide what are the interest rates at each of these nodes? There are different ways of going ahead with them. Most of the times they are very complex algorithms that are driven. But as a concept, okay, what I will look at is these are all like 1 period forward rates. These are all like 1 period forward rates. So what I can very well talk about is I can use the existing prevailing spot rates, based on the prevailing spot rates, or even before that I'll pick up all the on the run securities, and using these on the run securities, using the bootstrapping mechanism, I can derive the spot rates for all these periods, and based on the spot rates I can compute the forward rates for each of the periods. This, and okay, if I am computing the forward rate, I will get only one value, but I will use the volatility concept to decide that it can either come here or it can come here. Based on the forward rate and the volatility that is built into it, I'll create the two possible paths. From each particular path I can create the volatilities and make sure that it is created in such a way that for all the on the run securities that are currently available in the market, their value will be same as the market price. Value will be same as the market price. So based on those kind of algorithms, we will derive these interest rates at each of the nodes. But once I have the interest rates at each of the nodes, I have to be more and more comfortable in valuing the bonds or valuing the options on those bonds using these generated interest rate tree paths. So for that I will take up one simple example. Right, this is the same way we might have done the valuation of the bond or valuation of an option on the equity security also. The same logic we'll use for bond valuation. So this is called as a backward induction method, because for valuing the bond as on this date, when I have the interest rates at each of these points, when I have the interest rates at each of these points, I'll find out the value of the bond. If I have to find out the value of the bond as on this date, I'll try to find out what are the possible values for the bond as on these dates, and these values are arrived from what are the possible values of the bond as on these dates. So we work backwards. We start right in the maturity year, discount that to the year before it or a period before it using the interest rates that were prevailing at that point, arrive at all the possible values of the bond in that particular year, then again use the same concept to value it back to the current year. So because we come from the almost the maturity year back to the current period, we call this kind of mechanism to find the value of the bond as the backward induction mechanism. So we'll try to see how we can use this backward induction mechanism to compute the value of the bond. Okay, so for that we'll take this small numerical. Let me try to depict this numerical. Assume that the current 1 year forward rate is 5%. So as on today, I am assuming that the interest rate is 5%. As a notation, probably we can use a kind of a rectangular box kind of a notation. Here I can put the bond value as well as the prevailing interest rate. So if I am assuming that the 1 year forward rate is 5% and 1 year forward rate 1 year from now, so which means I am talking about a year from now, these are the possible paths. I am talking about either it can be a 6% or 7%. As a convention, probably it's better that we note the higher side at the top and the lower value at the bottom, both of them with equal probability. So even this can go at 50% and this can go at 50%. So we are talking about find the value of a 2-year zero coupon bond. So from a bond standpoint, so this is the 0 year, this is 1 year, this is 2 year. Means the bond is actually maturing at this particular point. So because it is maturing and it is a zero coupon bond, it will pay me a cash flows of 100, which is known. These cash flows are known. Whatever may be the path of the interest rate, I know that 100 is the cash flow that I would be getting at the end of year 2. So I can find out the present value at the end of year 1, assuming that 7% is the forward rate. So here also I can assume that the chances of upward and downward is 50. It doesn't matter, because at the end of 2 years, whatever may be the scenario, I will definitely get 100, because this is an option free, or this is a zero coupon option free kind of a bond. So with this is the first step. So what I'll do, I'll create in the spreadsheet, I will simply take these scenarios, right? I'll take this as 5%, probably here here I will take it as 7%, and here I will take it as 6%. And as far as the security is concerned, I know that it can give me 100. Whether whatever may be the path it is taking, it will definitely give me 100 itself. So what I will do, if I have to find out the value of this bond as of here, what is the average value of the bond as of here? It is 50% times 100 plus another 50% times 100. This is the value of the bond as on here. But if I want to find the value of the bond as on here, I will divide it by 1.07, because this is a 1 year kind of a rate. I will divide this by 1.07. So what is happening? The value of the bond as on this date is nothing but 0.5 times 100 plus another 0.5 times 100, whatever is 100 itself, right? Or probably I'll use these spreadsheet terms, 0.5 times this plus 0.5 times this. These are the values, divided by 1 plus 7%. So the value of the bond as on this date is becoming somewhere around 93.45. The same logic I can use here also to find out the value of the bond. So again, if I want the value of the bond here, I'll take, okay, there is a 50% chance of getting 100 and another 50% chance of getting 100. So this is the value as at the end of 2 years. But if I want at the end of 1 year, I have to discount it by the 1 year rate. So I'm saying that there might be a possibility that the 1 year, at the end of 1 year, the interest rate may be 6%. So I'm talking about the value here, which is working out to 94.34. Again the same logic. Now this is the value. There is some possibility for this value at the end of 1 year. Some possibility for this value. Again 50-50. So all I can do now is, I am saying there is a 50% chance that the bond will touch this number. At the same time, there is another 50% chance that the bond will touch this number. So this is the expected value of the bond at the end of 1 year. But right now, if I want what is the value of the bond, again I am discounting it with the current interest rate, which is telling me that my bond is worth 89.42 bucks. So the value of the bond in this case is 89.42. This is an option free bond, very straightforward. We know that it is maturing at the end of 2 years, so the cash flows are 100 at the end of 2 years. I am trying to find out what are the possible cash flows at the end of 1 year by discounting them with all the possible discount rates at each of the period, at the end of each of the periods, and again finding the expected value here, discounting them to the present. So we are actually working backwards right from the maturity period to the current period to arrive at the value of the bond. Now let's say just for understanding purpose, if this particular bond, this is a zero coupon bond, assume that this particular bond is having a coupon of 6% on an annual basis. How will I figure that out? If I know that 6% is the coupon, I know that every year that 6 is being paid. So what will happen? These numbers first I will modify, making all of them as 106 on maturity. That's the first step I will do. So again, 0.5 times 106 plus 0.5 times 106 divided by 1 plus 7%. But at the same time, in this year, there is an extra coupon of 6 that is coming up. There is an extra coupon of 6 because at the end of 1 year, there is a coupon of 6 that is getting paid, which means the value here is two things: the coupon that is coming in this year and the present value of the cash flows that are coming from the future. The current year cash flow is 6. The future cash flows that are reduced to the present value are going to be this. So what is happening? The value is becoming here 105 point something, and the same logic if I am applying here, I am putting a coupon of 6 here, which is working out to 106, and both of these things now discounted to the 5%, because here I don't get any coupon, I don't need to add. The current year I will not get any coupon. As of the cash flows, I will get a coupon at the end of 1 year and at the same time at the end of 2 years. So at the end of 2 years I have figured into this, whereas at the end of 1 year means after finding out the present value, I have added the coupon value to each of these numbers, and so there is a 50% chance that the bond value at the end of 1 year will become 105.65 or it may become 106. So again, discounting that to the present value at the rate of 5%, it is giving me that the value of the bond is 100.50. So now in this example, we have gone ahead saying that the upward movement as well as the downward movement, both of them are 50% itself. We have taken that the up movement or down movement, both of them are 0.5. So which means there is a 50% chance that the interest rates will go up or the 50% chance that the interest rates will go down. But in reality, that may not be the case. Or see, if I take the rates like this, it may not match the values of the on the run securities. One of the key important thing in this entire valuation analysis is whatever the rates that I am using, across, if I am using these rates to value on the run securities, if I am using these rates to value on the run securities, their value should be exactly equal to the market price. And it may so happen that if I am using equal probabilities of up and down movements, I may not be able to match the market price at all. So from that standpoint, if at all I have to modify these probabilities so that when I am doing the valuation of on the run securities, the value is equal to the market price, means instead of probably 40-50 for 50-50, I may have to come out with 40-60, or I may have to come up with 70-30, whatever is it. So that kind of probabilities that are getting assigned, so that we have to match the market price, that kind of probabilities we are calling as the risk neutral probabilities. So the risk neutral probability is that particular probability which will equate, I mean, instead of using 50% and 50%, if I take, let's say, 70 and 30 or something like that, it will equate the value of the on the run security to the market price, whereas the true probability is what are the two different possibilities that the two different interest rates can take. In general, we go with a 50-50. So the true probability is directly taken as 50-50, whereas the risk neutral probability is arrived from the valuation of the corresponding on the run securities with similar kind of maturities. The difference between the two is what we call as the interest rate drift. So it is suggested that before we get into the option valuation process or we get into the bond valuation process, we have to adjust either the interest rates or we are adjusting the probabilities. Either of those two we have to adjust so that the rates reflect very aptly or rates match the values for all the on the run securities with the market price. So the general process that is typically looked at is based on the current yield curve for various maturities. I arrive at the spot and the forward rates. I know the spot rates from the current yield curve, and based on that I compute the forward rates for different periods. So initially I take the forward rates for each of the periods. Then there are two steps that I can go. Either adjust these interest rates by keeping 50-50 probability itself, adjust these interest rates so that all the on the run securities are getting perfectly matched to their market values, and use those interest rates for finding the value of a bond or a derivatives or anything else. That is one method. Whereas in method 2, after you compute the spot and the forward rates like this, don't adjust the interest rates, rather adjust these probabilities so that we arrive at the updated probabilities of up movement and down movement, thus understanding the interest rate drift in the process and use those probabilities for evaluating the bonds or options at a future date. So at the end objective is you are using the risk neutral probabilities, not the 50-50 kind of movement. You are using the risk neutral probabilities of going up and going down to evaluate the value of the bond. So we'll use that approach to find the value of the bond or option on the bond, and try to have a good understanding of this entire process. The moment we take up one simple example, this will give us the entire decent understanding of the process. So we'll take this simple example. Just try to understand this numerical, then we'll get into the calculation aspects of it. We are talking about valuing a 2-year call option, European call option, on a 3-year maturity 6% annual coupon bond. Okay, let's look at so this is the current, this is after 1 year, right? This is the moment after 2 years, and this is the moment after 3 years, correct? This is the typical bond. So yeah, so as far as the bond cash flows are concerned, these are the scenarios. So yeah, because this is a 3-year maturity bond with a 6% coupon, I am assuming cash flows wise I will get 106 in at the end of 3 years. Whatever may be the movement of the interest rates in the between, I am expecting that I will be getting a cash flow of 106 at the end of 3 years, and a cash flows of 6 at the end of 1 year as well as 2 years, because this is a coupon kind of a bond. And the other information that is available with us is the risk neutral probabilities of up movement in year 1. 1 and 2 are 60 and 40. So here I am taking the risk neutral probabilities as 60 and 40, whereas here I am taking the risk neutral probabilities of up and down movements as 70 and 30. This is one more information. Assume that the 1 year forward rate now is 3%. So this interest rate is 3. And 1 year forward rate 1 year from now can be either 4% or 5. And 1 year forward rates are probably, I'll take here 5 and 4. 1 year forward rates 2 years from now are either 7.5 or 6 or 4.5. So these are the numbers that we are having at the end of each of these periods. So based on this information, I have to value or compute the value of the 1 year or 2 years European call option. Alright. So remember, so what I need to do, first I will go in the same way, computing the bond value at each of the periods. Computing the bond value at each of the periods. So here 106 is what I am expected to get. So I can very well fill in the bond values at each of the periods using my formula, right? So at the end, so I'll take this entire thing into a spreadsheet so that we can do it quite comfortably, right? So I'm assuming that 106, if the bond value is 106 at the end of 3 years, the present value at the end of 2 years, depending on the various interest rates, I can take it as 106 divided by 1.075 in case of the first route. So here the bond value for me is 98.60, the bond value here. The same logic I can use here, 106 divided by 1.06, I will get it as 100. So the 100 is the bond value at this particular point. So basically if I am going ahead with a tree, right, just a better representation, I'll go with a tree here depicting the bond values at each of the stages. This is where I need to get the bond values at each of the stages, whereas the interest rates for me, if I am going with a similar process, the interest rate here is 3%, here is 5%, and here is 4%, and here the interest rate for me is 7.5%, right? It is 7.5% here, this is 6% here, and probably 4.5% here. Now I know that the bond value is 106 at the end of 3 years, because this is getting matured and no impact on whatever may be the interest rates at the end of each of the periods. So here if I have to find out the bond value, whatever may be the proportion of up or down, it really doesn't matter to me. So on default I can talk about a 50% chance of going up or down, but that I am discounting it with this particular rate of interest. So it is saying that the bond value here is 98.6. The same calculation I carry it here, I am getting 100. And the same calculation, 50% of 1.6 plus 50% of 1.6 divided by 4.5%. So the value of the bond at the end of 2 years is going to be these kind of numbers. And now the next information I am talking about is the 70% and 30% of the movement here, whereas here it is 60% chance of going up and 40% chance of going down. So that information I have to incorporate when I am coming down to the year 1 node. When I am working at year 1 node, I have to take that into consideration, that there is a 40% chance of there is a 70, right? There is a 70% chance of going up and 30% chance of going down. So when I am computing the value here, I will take it as 70% chance of going here plus 30% chance of going here. So I am computing the bond values first of all. There is a 70% chance of going up and 30% chance of going down. That I am adjusting it with this particular rate of interest, which is giving me that the value is around 94.3. But to this number I have to even add up. I have to even add up the at the end of, see here I am going to get 98, fair enough. Yeah, but this 98, to this 98 even I am going to get 6 as the coupon. So here if I am looking at, I am even getting a coupon of 6 at this point. Even I am getting a coupon of 6 at this point, and also I am getting a coupon of 6 at this. So whatever may be at the end of 2 years, I am also getting a coupon of 6 in that year. The same logic when I am carrying it over to the year 1, apart from 70% of up and 30% of down, I am also getting a coupon of 6 in this period, taking the value to be something like this. Similarly here also a 70% of this plus 30% of this adjusted with the interest rate for this particular period, and also a coupon of 6. So this is giving me that the value at this layer is going to be 108. Then the same logic, there is a 60% chance of going up and a 40% chance of going down. So 60% of this plus 40% of this, these two things I am discounting it at the 3% interest, which is telling me that the value of this bond is going to be 103.83. For this kind of a bond, the value is going to be 103.83, assuming that there is no option that is available on the bond. Assuming that there is no option. So for an option free bond, I can say that the value of this is 103.83. Okay, so let me leave it like this, 103.83. Now let's say I want to introduce the option now, and this option is a 2-year maturity European call option. All are important for me. 2-year maturity European call option means it can be exercised only at the end of 2 years, and it can be exercised Okay, we will assume here that it can be exercised for a strike price of 100. So let me modify this question. 2-year call option with a strike price of 100. With a strike price of 100. So typically, because this is a call option, if the value is more than 100, if the value of the bond is more than 100, that is where this option will be exercised. If it is less than 100, it will not be exercised, right? So from that standpoint, I can very well compute the payoffs. From this standpoint, I can very well compute the payoffs. So at this point, what is going to be the payoff if I subtract 106 from each one of them, because I have just added 6. If it is more than 106, the difference will be the payoff. If it is less than 106, 0 will be the payoff. So probably here what I will say is, if this number is greater than 106, I will say this number minus 106 is going to be the payoff, otherwise 0 is going to be the payoff. So at this layer I am getting a payoff of 0, here also I am getting a payoff of 0, whereas here I am getting a payoff of 1.43. Now the same logic can very well be continued. The moment I know that these are the payoffs at each of the layers, I can work backwards, right? 70% chance. So the same interest rates kind of a scenario is what I can very well take, and I can go with a 70% chance. 70% chance of this particular payoff plus 30% chance of this particular payoff divided by 1 plus this particular interest rate. So this is going to be an overall payoff of 0. The same logic extended here, I am going to get around 0.41. This is the value of the option at this stage, whereas when I am working out at this stage, I will take it as 60% of this plus 40% of this, and both of them being discounted at 1.03, giving me that the value of the option is going to be around 0.16. The value of the option here is going to be 0.16. This is going to be the value of the call option, going to be 0.16. So if I subtract this minus this is what is going to come out as the value of the callable bond. So if at all the question is about finding the value of the callable bond, I can find out the value of the non-callable bond as if no option is present. I can find out the value of the option as I have highlighted there, subtract the value of the option from the value of the option free bond to arrive at the value of the callable bond. Or the other way of doing the same thing is, because the bond can be callable here, what you can do is find the price of the bond, right? If at all the price of the bond is more than 106, directly here you can take it that if the price of the bond is greater than 106, what we are saying, you will buy it at 106 itself. If the price is greater than 106, you will buy it at 106 itself. So what I can say is, if the price is greater than 106, keep it as 106, otherwise retain it as the original value itself. I will make that, if at all I have to directly arrive at the value of the callable bond without finding out the value of the call option or something like that. So these are the numbers that I'm going to get, and from here so these are the possible values of the callable bond. If at all the bond is getting called back, these are the possibilities that are existing. And here also, okay, now this is the callable bond. These are the values. So what I can do is for this, again a coupon will be added. So I'll add up the coupon here. Here also the coupon will be added. I'll add up, and finally I am ending up with 103.27 itself, which is what exactly is the one that I have got even when we have gone with this particular process. So either of the ways, either you compute the value of the option free bond and then the value of the option, subtract the value of the option from the value of the option free bond to arrive at the value of the callable bond, or you can assess, okay, if because this is a callable bond, when the market price is more than the strike price, you can obviously find that the bond is being called up and the price is going to be that strike price itself. Based on that assumption, you can very well build up this tree, work backwards using the backward induction mechanism, and finally arrive at the value of the callable bond directly. Alright, now in this entire process, one thing that we have to be worried of, or one thing we have to be aware of is, whenever I have built this tree, right, from 5%, I am talking about 7.5 and 6, we are actually going with the assumption of recombining binary trees, binomial trees, right. This is the same logic we have been using even in the equity options valuation and all also. From here we are talking about recombining. What is that recombining? Once it has gone up and if it is coming down versus it has gone down in the first year and then going up, we are assuming that these two, this point, the middle one, up and down versus down and up, both of them will reach to the same layer. This is one of the major assumptions as a part of the recombining tree. But in reality, it has been observed that probably once it has gone up, the levels of volatility are more different from once it has gone down. If it has gone down, probably the rate it can reach when it is going up, versus if it has already gone up, the rate it can fall as a part of the going down. These two things can be ultimately different, which means it may result in something like this. It may result in something like this, where 4, not 3 at the end of the second node, I may get 4, and similarly for each of them another 2 more. So like this, what happens is the size and complexity of the tree drastically goes up. These kind of trees are called as non-recombining trees, though it is good to use these non-recombining trees for the valuation of the bonds and derivatives on the bonds, but it makes the calculations more and more complex because we are ending up with so many possibilities towards the end. The calculations become more and more tedious, though it is an interesting feature, or though it is really good to go ahead with non-recombining kind of trees. It has several limitations in the process. Similarly, now apart from options and valuation of the callable bonds, the same interest rate tree structure can also be used to find the value of the swaps also. If at all have the interest rate tree structures. The same, probably using the same interest rate structure, right? If this is going to be the interest rate tree structure, if I want to find out the value of 2-year maturity 5% fixed pay swap. So 5% fixed pay swap is what I would like to evaluate at the end of the payments are being made on an annual basis. So the first thing that we would like to do is first understand what are the payments that can come from this swap at each of the periods. Okay, because this is an annual payment and we are talking about 5% fixed. So this, whatever is the interest rate value minus the 5%, interest rate value minus the 5% into whatever is 1 million. Probably let me keep 1 million as it is, because it would find, or probably I can treat it as 1 million in terms of numbers, whatever it is. So this is the amount that I am going to get probably during year 2, if the interest rate in year 2 is 7.5%. That's the way we can put it. If the interest rate touches 7.5%, probably I will get around 25,000 as the payoff. 7.5%, I will get 25,000 as the payoff. The same logic, if I go with, probably if the interest rate touch 6%, I'll get 10,000 as the payoff. Right, 6%, I'll get 10,000 as the payoff. And if the interest rate touches 4.5%, then I would, then if the interest rates touch 5%, 4.5%, then I would be losing 5,000 in the process. The same logic I can do for end of year 1. At the end of year 1 also, because swap payments are on an annual basis. So at the end of the year 1, when the interest rate is 5%, I would literally receive 0. But if the interest rate is 4%, it would result in a minus 10,000 as the payoff for me. Now I can work out in the same way. If at all I want to find out the value at this point where the interest rates are 70-30, first, apart from this particular payoff, I will find out the present value of these two payoffs. So this will work out at 70% of 25,000 plus 30% of 10,000. So this is my expected payoff of the next period, divided by whatever is the 5% interest rate. This is the present value of the next year's cash flow plus whatever is the current year's cash flow. This is going to be my current year's cash flow. So the value at the end of the first year, in case the interest rate is 5% and then the upward part, the value is going to be 19,523. The same logic if I apply here, I am talking about 70% of 10,000 plus 30% of minus 5,000 divided by 1 plus whatever is the 4% is expected interest rate, and along with that the current year's payment are expected to be minus 10,000. So the present value is going to be around minus 4,700. The same logic if I apply here, there is a 60% chance of getting this value plus 40% chance of getting this value, and this entire thing I am dividing it by 3%. So the present value of this swap is going to be 99,543 bucks for this particular swap. I am expecting that the value of this swap is going to be 9,543. So wherever the interest rate are volatile, we can very well compute the present value of that derivative by understanding the typical flow of process for that particular derivative, and then taking the cash flows appropriately, we can very well come out with the present value of the swap quite comfortably, or present value of the option. Any of these kind of derivatives can quite comfortably be understood by this kind of a mechanism. So the same logic, if I want to go for a puttable bond instead of a callable bond in this example itself, probably I could have directly taken, if this is less than 106, I'll replace it with 106. The reason being, in a puttable bond, I will exercise the option when the market value or market price is less than the strike price. So I will put up a simple rule here: if this is less than 106, 106, otherwise I'll keep it as it is. So that logic itself is sufficient for me to evaluate the value of the puttable bond. So in this case, it is coming out that the value of the puttable bond is going to be 104.38, which means the value of the put option for me is the difference between this and the 10 option free bond, which is taking it that the value of the put option on this particular bond is going to be $0.55. The same logic could have worked out even if I have directly worked out at the option level also, right? Just like the way I have worked out for the call option earlier. But one thing we are observing here is the value of the callable bond will go down, whereas the value of the puttable bond will go up, corresponding to the option free bond. In comparison with the option free bond, I'll observe that the value of the callable bond will go down, whereas the value of the puttable bond will actually go up, right? We'll use this information in one of our key findings which we are going to deal with very shortly. So and even with respect to the swap, we are comfortable in terms of how do I find out the value of the swap also. So any kind of a derivative security, we can very comfortably find the value of that once we have a very comfortable interest rate tree in place. Now in this swap example, we have actually gone ahead with a 1 year payment, 1 year tree structure. Now the wider I am using, if this interval is very long, 1 year kind of thing, probably I might not be reaching the accuracy in terms of the value. If you remember, we have used Black-Scholes model in the stock option valuation process, which was assuming very minute or continuous interval kind of scenario. So if 1 year is the time period we are framing for each step, then probably the accuracy of the model gets compromised. But if it is at very shorter time intervals, it would be more accurate, but the model will become more and more complex because I have to compute so many nodes and probably discount at various layers. So the binomial tree model, though it becomes more and more accurate in terms of valuation, but at the same time it becomes more and more complicated in terms of presentation also. So there has to be a kind of a trade-off between these two things. And at the same time, I cannot use Black-Scholes model, which I have been using for equity options quite comfortably to value the equity options. They don't work in case of fixed income options. The reason being some of the assumptions which are behind the Black-Scholes model. The Black-Scholes model assumes that the risk-free rate of return is constant. Whereas if we are seeing in most of our fixed income derivative calculations which we have done some time back, we are seeing that the interest rates will keep changing. So if the interest rates are changing at each of the nodes, and because of that the value of the bond will change at each of the nodes, means the interest rates are nowhere constant during the expiry of the option. See, the assumption is the interest rate is constant for the period of the derivative security until the maturity of the security, of the derivative security. But this is a 2-year derivative security in our earlier example. The interest rates are assumed to change at the end of each of the periods, which has actually resulted in the different values of the bond at the end of each of the periods. So directly the Black-Scholes model cannot be applied because the interest rates are not constant. And the Black-Scholes model, it has also assumed that the sigma is constant, the volatility is constant, the volatility of the prices is constant across the period of that particular derivative security. Whereas what we observe with respect to fixed income securities is, because they have a maturity period, when they are approaching closer and closer to the maturity period, we see that their volatility comes down drastically. Here their volatility may be very high, which is when they are very far off from the maturity, but the more they are approaching the maturity period, their volatility becomes more and more lesser. So which means the volatility is not constant throughout the entire period of the option, means I cannot use the Black-Scholes model even from that dimension. And at the same time, the Black-Scholes model, if we remember, it assumes that the prices follow a geometric Brownian motion path, which means there is no upward boundary. Probably there is nothing called mean reverting nature. The prices will in a long period probably will be either moving upwards or moving downwards. Not too much of a mean reverting layer, and what we are assuming is there is no upward bound at all. Whereas when we are talking about a fixed interest securities, that is not the case. There is an upward boundary. So keeping all these things in mind, the Black-Scholes formula, which is designed to value equity options or forex options, may not be applicable at all when it comes to the fixed income based options. So that means I have to rely heavily on the binomial tree model approach itself to value the options that are embedded in the bonds. And now just using the numbers from our spreadsheet, when I was talking about an option free bond, the price of it was 103.83, whereas for a corresponding callable bond we got the price as 103.67, whereas when we were talking about the putable bond we got the price as 104.38. So the price of the call option here is $0.16, whereas it is $0.55. Even if I go with a typical understanding of the price yield relationship, this is the yield versus the price for an option free bond. This is the yield versus the price for an option free bond. And now what we are saying is, below a particular price, if the interest rates are going lower and lower and lower, so what we can see is, as the interest rates go down, the chance of the bond being called will increase. So the price of the call option actually will keep increasing, which means for a callable bond, at this particular rate, let's say if the price of the option free bond was 103.83, the corresponding price of the callable bond was only 103.67, and this gap is nothing but the price of the call option. So what we observe is, instead of taking this kind of a convex path, the callable bond will actually take this kind of a path, which is what we call as negative convex. It doesn't go increasing with the decrease of the interest rates, but it keeps falling, because the option bond, the chances of exercising the option will keep increasing as the interest rates keep falling and falling, only up to this. But after a certain layer of the interest rate, what we observe is the callable bond versus an option free bond, both of them behave in the same manner. Only at lower interest rate the chances of the bond being called are increased, because if the interest rates are lower, the bond prices are higher. The bond prices are higher means the call option will be exercised at the strike price, so which means the value of that particular bond will actually come down, which means it takes a kind of a negative convex kind of a shape here. And because the fluctuation is not at this layer, the fluctuation is only at this layer, even the volatility of the bond price will come down. Especially in case of a callable bond. The same way, when we are looking at a putable bond, after a certain rate of interest, we see that the value of the putable bond actually will go up. We have seen the example that it has gone to 104.38. If this has been here, a putable bond would have been at this layer. The difference between these two is the price of the put option. The same logic again, the volatility is coming down because the drop is not by this much extent, the drop is only by a nominal extent. So even the volatility will come down in case of a putable bond, and the gap is because of the value of the put option. So as and when the interest rates are increasing, we see that the putable bond will carry a higher value. If the interest rates are decreasing, we see that the callable bonds will carry a the callable bonds will carry the value of the callable bond will actually go down, because the price of the call option will keep increasing. So another way, value of the callable bond is equal to value of the option free bond minus the call option, whereas the value of the putable bond is the value of the option free bond plus the put option premium. So these two relationships also, if you remember, it can definitely help us in understanding the behavior of each of these bonds, which we can use for our real life investment kind of decisions also. I hope the understanding of the interest rate tree and how we build the interest rate tree and use risk neutral probabilities kind of measures to value the call option or a put option or even an option free bond, or finding out the value of the callable bond or a putable bond, or even valuing any other interest rate based derivative security. Right? In case you have any other further queries on these lines, please feel free to get in touch with me on the number that I have given below, or you can even send in an email at vamsidhar@peacegurus.com. I can very well get back to you with the relevant clarifications to the same. Thanks a lot for listening to this session. Thank you very much.